Good evening, everyone. Thanks for joining this call on time on the session of retirement planning. Gentlemen, I request you, ladies and gentlemen, I request you to pay attention over the next 1 hour. And let me assure you, over the next 1 hour, you will have reasonable insights into the subject of financial planning and retirement planning. Friends, I just started my retirement planning and financial planning journey back in 2010. When we used to interact with investors, we realized the investors' investments are not aligned with their goals, especially when we are talking about corporate executive salary class individuals. That's when we realized that investors require a holistic planning, not a piecemeal service or products. So ever since I've completed my certification back in 2010, and post that we have been committed to investor education and helped hundreds of investors in their retirement planning. Friends, over the next 1 hour, I'll attempt to cover this agenda. We will try to address the most important questions like why retirement planning, what is the right time to start planning for retirement, how much do we need to retire comfortably. I think this is one question that everybody wants to know. Are we ready for early retirement? I think back in good old days, I think we used to see everyone completing their the full service. But of late, when we meet individuals, I think we meet a lot of them who opt for early retirement. Right? So we'll also check whether we are ready for an early retirement. So we'll also discuss about what are the common mistakes people make, that we observed that people make during their retirements, how to choose the right investment for the required investment need. We will also talk about dilemmas faced by investors. I think if you are able to cover this ground over the next 1 year, that will be really interesting and fruitful. But before we get in, let me also clarify, retirement planning comes under part of financial planning. So because financial planning is a holistic thing, retirement planning is the most important, but part of financial planning. I'll also talk a little bit about financial planning. So let's begin the webinar with asking ourselves few questions. That this is more like a financial health checkup. So starting with, can we manage our finances without salary for the next 6 months? See, I started my working experience from 93 December. So ever since I have not taken a single month break. So though I have not shifted many companies, so I've been continuously working. So during my 32-year journey, one thing that is common is that every month I've been receiving my salary. And that should be true for most of you. Some of you may have been retired, right? So most of the times we are so used to receiving that most of our expenses, planning, everything is aligned to receive or dependent in terms of receiving that particular income into our bank account. And we take it for granted over a period of time. And what all of us will have to face at a point of time in our lives is that salary will stop coming into our bank account. I think that's a very important event. Let me talk about the case. I have a neighbor who used to work for ISRO. And then about 10 years back, he's a scientist, a very senior scientist in ISRO. About 10 years back, he joined one of the software companies as a very senior position. The division was profitable. For some reason, they've decided to wind up the division. He was 55 then. At 55, he was well off. Financially, I think he's secure. But 3 months into not receiving salary, he just expressed his feeling that, okay, he's feeling very, very uncomfortable. So while in his case, he's financially secure, financially free, but not receiving the salary for a 3-month period has put someone so secure into probably a feeling of uncertainty and feeling of insecurity. I think this can happen. I think unless we all prepare ourselves into replacing that salary into some kind of cash flow that is coming into our account, I think it's not a very happy situation. So one is that I think this is like how many of us are comfortable manage our finances without receiving the salary for the next 6 months? And are we prepared to deal with an emergency? Emergency can be any kind of emergency, be it medical. I think emergency involving large financial outflow. So that is one part of it. And do we have a plan to achieve all our financial goals? Some of us have defined, some of us have not defined. I think those of us have defined the financial goals. I think it's very, very important that we have a clear-cut plan in place? So we will cover a bit of that today also. And do we also know what is the right investment product to suit the right requirement, right financial goal? See, when we meet people, when we look at portfolios, I think portfolios are managed in a single large bucket into one particular umbrella. But while financial goals are required, money is required for every financial goal at a point of time. So there are some financial goals where you require lump sum, say for example, maybe son's wedding, daughter's wedding, or some education, or any of these things will require some lump sum amount, right? At the same time, there are some requirements. Say for example, every year we'd like to travel, probably every quarter we'd like to travel. So and likewise retirement, they all require cash flows to happen at a regular periodicity. So whether we know that, okay, we've got the right investment product to suit every financial goal. And how much amount do we need to retire comfortably, that we've already addressed before. And do we have sufficient life cover, which is very important. And again, healthcare policy. Healthcare expenses have gone up, and it's very, very important for all of us to have a good and right healthcare policy. So this is a financial check. I think probably each one of you can probably write down your answers against these questions. And generally, when we meet people, I think most of my talk today would involve not from textbook examples, but from real life examples, wherein I had the privilege of meeting maybe thousands of investors. So wherever I go, I meet people, I interact with them, I learn. There are several people from whom I've learned from their experiences, from their wisdom, everything. So I think that gives me a lot of case studies to talk about, and probably that gives me also a knowledge to share with all of you on the do's and don'ts, right, with respect to investments. So all of us understand inflation. Even my young kid also understands inflation. He demands higher pocket money because of inflation. But I think we don't understand really the impact of inflation over a long period, what inflation can do over a long period of time. So why do we talk about inflation? Because when we talk about retirement, we are talking about a period of anywhere between 20 to 30 year period, or it can be more. So when we are talking about such a large period, inflation is something which is going to be wreaking a havoc on our planning. So we will also look at that. So in my view, not many of us are prepared to tackle the inflation impact. Second thing, a long retirement I've already spoken about, and I have observed in few cases, the individual is already retired, two sons, one is pursuing a PhD, probably 32, and the other one is pursuing MBA, 28. They are still not settled. Probably we expect kids to settle by the time, and even aging parents. I think this is something that we cannot say no to their responsibility. I think so. We are responsible to take care of both our elder kids and then aging parents financially until they settle down. So I think that is one thing that most of us don't prepare for. So medical crisis, we don't know, depending on what crisis it is, what kind of financial, emotional, mental stress it can cause. Marital breakdown used to be rare in previous generation. I think it became more common of late, and death of main family members. I think these are all the situations that can upset the financial situation. So it's very, very important that you have a plan in place which can help you weather this kind of situation. So let me also briefly touch upon the subject of financial planning. What is financial planning? What it does? What it does not? When we talk about financial planning, it is not objective of financial planning is not to maximize returns. Let me give an example. If somebody says, I've got my daughter's wedding coming up in the next 1 year. Here the goal is to make the funds available to the individual at the right time. Here my goal is absolutely not to maximize returns. So if the money is lying in the bank account, I would rather tell him to leave the money in the bank account, bank FD, which they can liquidate any point of time, or a simple liquid funds. So goals like this, I think the objective has to be making the money available to the individual at the right time compared to maximizing the returns. So there are other goals where you can actually talk about maximizing, not in this particular case. But to improve the chances of achieving your goal, that's what I'm saying. Making the money available at the opportune time, at the right time, is the objective compared to maximizing it. Help you make informed decisions like early retirement. We've actually helped a lot of individuals take this call. There was an individual who works for a large hotel chain based in Chennai. He was 45 when I met him. He was contemplating retirement at 45. So we did the math, told him that, okay, there is no way he can retire until he's 50. Because what are the savings that he has got till that time? He was believing that that's sufficient, but we've actually calculated, told him that he has no chance of retiring for the next 5-year period. So that has helped. Likewise, okay, we've also worked with a couple in Delhi. Both of them had no idea of early retirement, but when we did the complete planning, they realized that they had more than enough to comfortably retire. They have actually taken a call in terms of early retirement. Of late, I also meet doctors who contemplate early retirement. If not early retirement, they'd like to create a financial plan that helps them take a call, right? So it helps you prioritize your financial goals. Also allows you to focus on your passion and hobbies once the goals are achieved. I think so. It's a very, very important. Financial planning helps you lead a comfortable, stress-free retirement life, or even pre-retirement life. So what are the challenges we have got now? So inflation is something that we spoke about. Apart from inflation, we also have lifestyle issue. I think if I talk about my father, he was a doctor. Throughout his life, he's used only 2 bikes. One is a ESD, second one is Vespa. And then towards his retirement, he bought a car. So he's got literally no upgrades, no need to change the mobiles frequently, no need to upgrade those cars. Lifestyle is by and large remained. But coming to us, okay, most of us can relate to this. We are all compelled to maintain the lifestyle. We have the urge to change the mobiles maybe every 3 years. Not just us, the family members. Everyone wants to upgrade, right? So we do have cars which we need to upgrade maybe once in 5-year period. So I think this is the problem that we've got living in gated communities. I think then there is a big pressure coming in. So not just inflation, we spoke about lifestyle, and also with so many distractions, so many spendings, I think investment discipline becomes difficult. Since we're talking about inflation, let's actually see what kind of impact can inflation have over a long period. So let's look at the table. What it shows is that today you have 1 lakh rupees coming in, assuming that you planned for 1 lakh rupees cash flow and your requirement is today is about 1 lakh rupees. And with about 6% inflation can be 5%, 6%, whatever it is. So this calculation is done with about 6% inflation. How your purchasing power is dropping year on year. I think in the initial periods, from 40 to 41, 41 to 42, the purchasing power is dropping to 94,000, 89,000. This is the year on year decline in the purchasing power. And if you look at column J, this is the amount that is required to maintain the same lifestyle. So if you are talking about 1 lakh, if I need to continue maintaining the same lifestyle, I require at least so much amount, right? So to offset the drop in purchasing power, I hope you were able to understand. Just let me explain again. Now for the age 45, I require the same 1 lakh rupees, but my purchasing power with the same 1 lakh rupees is dropped to 74,000. To maintain the same lifestyle after 5 years, instead of 1 lakh rupees, I require 1,33,000 rupees, right? So let's move maybe 10 years down the line. At 50, the 1 lakh purchasing power has actually dropped to 55,000. Now I require almost 1,80,000 to maintain the same lifestyle. So number one, the value of the money is dropping, the purchasing power is dropping, and your requirement to support the same lifestyle is actually increasing. And there is no way fixed income, fixed deposits, or any conservative securities can actually help us meet this. I think the last column what we have is an FD giving us a net of tax of 5%. How is that going to help us take care of this one? So it is much below our requirement. Now because we are talking about retirement being such a long period, so let us move 20 years down the line, which is 40 to 60. So let us assume that you actually retire at 40. Then 20 years down the line, your purchasing power is actually dropped to 1/3, less than 1/3. You actually require 3,20,000 rupees to maintain the same lifestyle. So the numbers are alarming. That means, okay, so if somebody doesn't have a product that takes care of inflation adjustment, so going too conservative will also mean that the money that you are having is actually losing its purchasing power over a period of time, and then you have no chance to maintain your standard of living. So I think standard of living cannot drop to 1/3. Standard of living, maybe intentionally you can drop it by 10%, maybe 15%. You cannot drop by 60-70%. There is no way you can do that. So what is very important is that you need to choose the right instruments over a period of time. So let me just take the example of a diversified mutual funds. Here we've assumed that a diversified mutual funds historically has given 12%. We've assumed that they can give you 12%. So let us assume that, okay, 5 years down the line, your actually requirement is about 1,33,000, but the mutual fund value has actually grown to 1,76,000 at 12%. Should you put in everything into mutual funds? May not be. So, but this is one instrument that can help us beat the inflation comfortably, right, over a long period. So I'm just looking at the math at 20 years down the line. 20 years down the line, I said my requirement is changing to 3,20,000 rupees. But the same thing 20 years down the line at 12% compounding, my amount is actually growing to 9,64,000. So I think this is the magic of compounding over a long period. So that is known through example. So as we start earning, I can relate this to myself. So actually started my journey buying a car once I got married. Then I bought a car. Then got into buying a home. So I actually bought a home which is a little bit more expensive compared to my affordability. I think that's what most of us end up doing it. I've done that mistake again, maybe at 45, buying a house beyond my affordability, but that turned out to be a blessing in disguise in terms of appreciation of the value. So I think if you look at how all of us start our journey, we all start probably from buying a car, some of us maybe buying a home, then all of us require emergency funding, and then when children are born, we focus on their education. None of us want to compromise on education for children. Then none of us also want to compromise on our holiday. I think this is a generation which wants to holiday a lot. And even when some of our kids are settled abroad, we have the compulsion to visit them at least maybe twice in a year, and we'd like to all of us like to be independent. So when we don't compromise on any of these areas, retirement is actually coming last, right? Because you cannot think about retirement at 25, 30. Most of us don't do. Even I have not done that at 35, 40. But by the time one touches 40, let us assume that, okay, priority becomes, education has also become so expensive. Priority becomes education. Probably I'm already servicing a big home loan there. So then I cannot compromise. Every year I need to go on a holiday. So where is the question of me saving for retirement? Unless I consciously approach that. We will also talk about math behind retirement separately. So assuming that even I'm able to achieve it, my next goal is basically wealth creation and legacy planning for my next generation. So these are the common goals. So and then there is a planning required to support and service every goal, right? So we've already spoke about why retirement planning is essential, because we're talking about a long period, anywhere between 25 to 30. Especially those cases where people opt for early retirement, there is even more longer time. So I can talk about one case. There's a gentleman who worked for a large MNC bank. He reached a top position at the age of 40 itself. Some reason he's taken a call to retire at 40, at the peak of his career. The reason being, he said, most of my colleagues who are actually continuing until late their 50s, maybe 55s, I've seen most of them are compromising on their health. He did not want to compromise on the health. He felt that the savings that he's got, ESOPs, everything that he's got by the time he's 40, is good enough for him to lead a comfortable lifetime. And it was actually a good amount. So he's actually invested half of that amount into real estate properties. He bought real estate properties everywhere, and then balance amount into stocks. So it was around 2018. He, for some reason, he's actually decided to invest the entire corpus into mid and small caps, and not just invest into, he's leveraged that. He's actually leveraged that using options and futures. So we had a major fall in the small and mid cap category in 2018. That time he's lost most of his investments because it's leveraged. Also, market mid and small caps have eroded by more than 50% that time. So he's lost most of his. He had to actually fall back on his land, basically real estate investments, to recover from that, because now when you make a mistake, you cannot recover from that. I think retirement is one period where the scope for making those mistakes is very limited. Now, if somebody is making a mistake at maybe 25, 30, or even 35, can recover from those mistakes, right? So I think that's one thing that I want you to keep in mind. End of active income, we all know that, okay, so salary is going to stop, which we are used to receiving it. And one more thing, during our working lives, what happens? We never feel the inflation, basically because year on year we get appraisals, we do well, and then we are rewarded year on year with increments and then bonuses. So those increments and bonuses most often take care of this inflation comfortably. So you never feel the pinch of inflation during our working life. But once you retire, there is no increment that is happening, okay, in terms of our investment, unless we plan our investments properly. The inflation is anyway going to rob our purchasing power. I think that's one thing that we'll talk about. So inflation is the next one. Higher healthcare costs, limited recovery time. If we make a mistake, that's the limited recovery time. So I think now I'll get into the subject of how much amount do we actually require to retire. We made a simple calculator to explain, depending on what age you are. There is someone who's asked, I think we've received a host of questions. Somebody who asked, I'm already 60, so you also talk about someone who's actually not yet to retire but already retired. Okay, what is it? Okay, we are of course going to cover those areas also. But first let me cover, I think, those of you who are at 35, 40, 45, 50. So depending on what age you are going to retire, it could be 60, 55, what are the amount. Here we have taken 60. And we've also assumed life expectancy of about 85 in all these cases. If your monthly expenses is about 2 lakh rupees, we've just taken one case, right? And you have about 15 years to retire. So I'm assuming about 35, you're 35. We will talk about those rest of the examples also. If you're 35, you still have 15 years to retire, and you have a life expectancy of 85. And then your current expenses is about 2 lakh rupees. So post-retirement, you would like to receive equivalent amount of 2 lakh rupees. So the time that you retire, because of inflation, the requirement to maintain the same lifestyle has actually gone up to 8,58,000. This is the monthly, first month of your retirement. To maintain the same lifestyle, your monthly cash flow has to be 8,58,000. These are overwhelming. But good news here in this particular case is that he's got 15 years left to plan for his retirement. Actually, it is actually 25 years. Sorry. It's actually 25 years to retire. Right? So during the 25-year period, the total retirement fund he has to have in the next 25 years is actually 20 crore 54 lakh rupees. Let us take it as 55 lakh rupees. The number looks large, but today, if he is able to invest, if the person is able to invest 1 crore 20 lakh rupees towards his retirement fund over the years, I think in about 25-year period, that will become almost 20 crore rupees. Or if the person is able to commit 1,09,000 rupees SIP every month systematically, that will also lead to 20 crore rupees. So this is the simple math to show that how over a period of time, longer period of time, your requirement is going up substantially. If you talk about anyone who's 35-year-old requiring 2 lakh rupees, not many of them will think about creating a retirement corpus of 20 crore rupees. But good news is that the person has got a lot of time to build that corpus. Let's now move to the second example of somebody who's at 45, right? So somebody is at 45, retiring in about 15-year period. So now the 85 life expectancy, monthly expense of 2 lakh rupees. The person requires in the first month of retirement 4,79,000, almost 5 lakh rupees. And this person will require almost 11 crore 50 lakh rupees as retirement corpus. And one-time investment. Today, if the person is able to invest at 45, is able to commit lump sum of about 2 crore 9 lakh rupees. That will mature as 11 crore, and then which will take care of the person's retirement. And if not, so the person can also do an SIP. So, or he can say that I'll put some amount lump sum and then also give you balance amount. So everything can be customized So these are all the standard things that we prepared. But when we work out with you individually, we construct a plan that exactly suits your requirement. So as the age matures, so if you see by the time 50 happens, right? Okay, so you've got only 10 years to build a corpus that sustains over the next 25-year period. So the time of 50 is like a red line. Okay, time of 40-45 is an ideal period to start planning for retirement, but not beyond 50. We will also talk about those scenarios. So let's also talk about some of the surveys. There were surveys done by famous institutions. Economic Times has done one survey. They've also conducted survey year on year, but I'm referring to one in 2024. So they've actually surveyed those people who are below 40 and above 40 also. So let's look at what the survey is talking about. Respondents below 40 years of age, most of them did not consider retirement as part of the top 3 priorities. So what will be the priorities of someone who's the age of 40? Maybe an EMI, buying a house, education of the children, maybe holidaying, whatever it is. So at the age of 40, there's a lot of EMIs happening because there's a car. Most of us buy cars which are beyond our requirements, or even houses much beyond our affordability, right? So people are flooded with this kind of EMIs by the time 40. So retirement is a distant requirement because it's not coming in. You still have 20 years. You don't even think about it. So 23% of the respondents, what they said, they have not even thought about saving for retirement. This is what I'm talking about. Now they also interviewed people who are above the age of 50. 4 out of 5 people above the age of 50 felt that they should have started planning for retirement earlier. Right? So by the time 50, you are in a sense of urgency. There is a sense of insecurity because you know that okay, you've got only 10 years left. In this 10 year, you need to actually save enough, and then you also have the ambiguity of how much is sufficient. Unless you are guided by someone who is professional, it will be difficult. It will be a very, very confusing status. And let's also, again, 4 out of 5 people above 50 felt their savings might not last through the retirement period. Now, these are not the era of living in a joint families. We are all living in nuclear families. And this is not the era to depend on children, right? I'm sure of so retirement planning, when we talk to a lot of people, so today, believe me, I don't find many people who are completely prepared for retirement. Ultimately, we identify how much amount is required to retirement, which we have already seen that. When we talk to you individually, we will also construct a plan that suits you most. Now, I know the amount that I need to save. I'll tell you that, okay, you probably require an SIP of 1 lakh rupees, SIP of 2 lakh rupees, a lump sum of 2 crore rupees. Then where to invest this amount? So there are 2 phases here. One is pre-retirement, second one is post-retirement. Now, pre-retirement, our goal is basically to increase the probably rate of return, grow the corpus. When we have periods of 15-year, 20-year, 10-year period, so this is a long term. So equities are the best classes where we can do that. Though we all follow asset allocation, but predominant amount of this investment during this phase of accumulation goes into equity related. Right? Once you accumulate, then the disbursal happens. Then you actually retire. Then you need to create those cash flows. Now, should you continue to have equities, everything? We meet all kinds of people. We meet those people who say that, okay, I have the capacity to handle the risk. I anyway have the surplus amount to withstand this kind of shocks. I don't mind taking the equity. But generally, we don't recommend complete equity post-retirement. What portion of equity? Everything depends on case to case. There are hybrid instruments today. So there are balanced advantage mutual funds. There are aggressive hybrid mutual funds, which has a combination of debt and equity. Right? When you have a combination of debt and equity, it will take care of the balance. It will take care of the inflation. Let us look at. I think so before getting in that, so let us look at the plan that I am going to give you for retirement plan. According to me, should satisfy these 6 conditions. Right? So probably you can put every product that you consider through this matrix. This is a filtering. You can call it filtering matrix, whatever it is. So every instrument that we take it has to pass through these 6 tests. So what are the 6 tests? Number 1, the instrument that I invest for my retirement planning should be able to generate cash flows, because I need a replacement for salary. Right? My salary has been coming in, it's going to stop at a point of time. Now I don't need to worry about whether something is coming in, whether I need to plan month on month. I need people who will be doing a lot of exercise to create that monthly cash flow. In my view, that should not happen, because you could do that maybe at 60, 65, 70, but not beyond 70. So the whole purpose is that retirement is you focus on something else, okay, not on generating this kind of cash flows. But with proper planning, you can always ensure that your bank account is credited with necessity amount, just like a salary, every month on month without any ambiguity. So number one requirement is that what are the investment that I'm making for my retirement has to give me a predictable certain cash flows every month on month. Number one. Number two, because we've already seen the impact of inflation over a long period, I also have the requirement to beat the inflation. So the instrument should be able to help me beat the inflation. The third one is that, okay, it has to be liquid. Liquid means I should be able to convert into cash as early as possible. Though retirement, we don't recommend that, okay, you should touch that corpus, but post-retirement, every investment that you make, most of it has to be in liquid. I think we generally don't recommend any lock-in products where your investment is locked in for a period of maybe 3-year, 4-year, 5-year period. That we don't recommend. So the third requirement that we're talking about here is liquidity. So then we also need to take care of tax efficiency. It should not happen because if you take fixed deposit, you are paying tax at the highest tax bracket. We don't know what kind of incomes we'll have post-retirement, but we'd like to keep it as tax efficient as possible. So number 4 is tax efficiency. Number 5 is that there has to be a right balance of risk and return. So some of you have sent questions. Okay, I was going through that. Somebody wants a safe return of 12%. There is no concept of safe return of 12% today. If you talk about safe return, probably safe return can only be 6%. Right? So every element of higher return that you expect carries a element of risk along with that. So we cannot avoid risk, but we can only minimize risk. So an instrument that I choose has to have limited risk, but also give me a meaningful reward. And finally, when I'm giving you a plan for the next, say for example, you are at 50, your retirement is happening in the next 10-year period, and then you have a post-retirement period of 25-year period. So overall, I'm giving you a plan today for about 35-year period. When I'm giving you a plan for 35-year period, I'm going to retire in between, right? And most of us, we will also retire. So what happens? Okay, so the plan that I give you has to be so simple that you don't have to worry too much about managing it. So I think this is one more thing that I take it so seriously, that any plan that I give you for retirement, it should not be complex. It has to be so easy for us to manage. Even at 70, 75, you should not have the worry to manage. Right? So what instruments, let us put through all these things into this filter. What instruments can actually put through this? So let us take the example of FDs, cash. FDs probably on a quarterly basis you can receive it. Maybe some FDs can generate you monthly. Will it beat inflation? No. Is it liquid? Maybe to an extent possible. Is it tax efficient? No. FDs are not tax efficient. So risk, probably there is a limited risk. Is it simple? Yes, it is simple. Let us talk about real estate investment. Does it generate cash flows? Probably there is a rental income. If you get rental income, does it beat inflation? Possible. But liquidity, it's very, very difficult to liquidate a real estate property unless the certain conditions are met. A property which I felt can be liquidated in 3-month period took me about 8 years. Right? So I think that's a cycle. Probably if you're stuck in a bad cycle in a real estate, that's what it could take you a very long period. Right? So tax efficiency may not be. So the income that you receive on the rental is taxed in the highest tax bracket, individual tax bracket. Risk, probably real estate, you understand the risk better. Risk of liquidity, probably there can be other associated risk. Is it simple? So you need to take care of the maintenance of the real estate property and everything. So I think you need to keep paying property taxes. So everything. So I think that there is probably I would not call maintaining a real estate property so simple. Probably it requires probably some care. So when I put through this matrix, hybrid mutual funds, I think probably that fits into every category. When I look at SWP, most of you must have heard about systematic withdrawal plan. So when you work on systematic withdrawal plan, they generate predictable cash flows. I can actually ensure that if you require about 2 lakh rupees, 5 lakh rupees, I can ensure that that amount is hitting your bank account systematically. Only thing, maybe once in 3 months, we feel the pinch of inflation. That's when, okay, we can reset the amount. All that you need to do is one exercise, maybe once in 3-year period, you need to communicate a revised amount. We are going to give you a calculator. You just need to communicate a revised amount so that, okay, that can be reset. Does it beat inflation? Yes, we believe it beats inflation. Historically, these kind of funds are given about 10% kind of return. Hybrid funds that I'm talking about, which has a component of both debt and equity. Of late, you've got also new category called specialized investment funds, which are also worth looking at it because they also have potential to minimize the risk by hedging the portfolio. So they can also do SWP. So that's one more thing that we can consider. So does it beat inflation? Yes. Are they liquid? You can liquidate them any point of time within 2 days notice period. Are they tax efficient? So the long-term capital gain that you pay is only 12.5% as of today on SWP. And that too, if you are withdrawing about 2 lakh rupees, the tax is calculated only on the profit that is made on 2 lakh rupees. Because the 2 lakh rupees has a component of principal plus capital gain. So tax is charged only on the capital gain. Does it have the right balance of risk? Because it has a mix of debt, equity, SIP I'm talking about, they can also minimize the risk by using derivatives. Yes. Is it simple and easy to manage? Yes. So when we choose some stable mutual funds, so you don't need to review the portfolio less than 6 months. I think every 6 months you just need to look at it, how they're doing it. That's it. You don't have to do much, right? Unless there is a change in the fund manager, there is a regulatory issue, you don't have to change the funds. Let's address the dilemmas faced by investors now. We do have questions from investors as to, is it right to invest into stocks versus mutual funds? Let me tell you, with my experience, if you are a trader, short term is always okay. But if you are a long-term investor, in my view, passive style has helped. I have not seen many people who are able to beat the indexes or mutual fund return through long-term investing into stocks. The reason being, people end up holding too many stocks. Why do they buy too many stocks? Because nobody likes to book loss. So because universally nobody likes to book loss, you will be left with a bunch of stocks which are not performing. So that becomes a permanent portion of the portfolios. And this we have seen practically with 95% of the people. I've seen this same phenomenon with somebody who's managing a 5 lakh portfolio or even with 500 crore portfolio. So people end up having bad stocks. Now the problem with having bad stocks is that if the proportion is higher with 30-40% of the bad stocks in the portfolio, there is no way portfolio can generate maybe 15% or even 12% kind of return. So this is the reason why we've seen most of the individuals are not able to beat the markets. Now, in that choice, I think mutual funds are a good quality PMSs are better because they're professionally managed and we can track them over the last 20-year period. So most of them exist for the last 20-year period. So whether we should see, when we review mutual fund portfolios, we also see a lot of sector funds. Somebody would be looking at IT, somebody would be looking at pharma, somebody would be looking at energy. So what we have personally seen is that it is very difficult to time the entry and exit of a sector. And we've seen a lot of cases where people invest in a sector when it looks attractive for them. And how does it look attractive? Basically because it performed better last year. And all of us look backward and decide whether it's going to be good for us next year or not. This is psychology. So when you look at, say for example, in 2012, when we look at which is the best sector which is performed, it is the bank X. And normal psychology tells you that it makes sense to invest in the same sector. Now next year, 2013, let us look at what bank X has done. That is that's the worst performer. Now let us look at 2013, the best performer is tech. That is again the worst performer next year. It doesn't mean that, okay, so you can actually pick up the worst performer and expect it to be best performer. So if you go by that logic, invest in tech here, tech is not necessarily the best performer here. So what I feel is that, okay, for you to win the game of sectors, your entry and exit have to be aligned, which is difficult to manage. So our recommendation generally is that leave the decision to the fund manager only. So when you are investing in a flexi cap, large mid cap, or even a simple small cap or a mid cap, the fund manager is actually choosing what sectors to be in. right? So this tells us that okay, it's difficult to make money investing in sector funds. Then whether we should go for PMS or mutual funds, mutual funds are tax efficient. You are investing in today until you exit. If you're not exiting for next 10-year period, there is no concept of advance tax. There is no concept of paying anything in advance. So until the exit, you're not paying anything. There is no cash outflow. Same the case with PMS. PMS, the fund manager is managing a portfolio on your behalf. There is an entry that is exit that is happening. They all pass short-term and long-term capital gains for you. So which you need to also pay advance tax. But if there is one PMS which is able to beat all mutual funds by about maybe 6% over a long period, which means significant. So there are few PMSs which have been able to, over a long period, are able to consistently achieve better returns. So I would generally talk about a combination rather than either or. So generally when we create portfolios either entirely mutual fund or somebody who's willing to take that extra risk and then aim for higher return. We generally create a portfolio with about 60-70% into mutual funds and balance into PMS. I think real estate, we already discussed about it. So specific to real estate, illiquidity, everything. So I think maybe we can have some real estate which are especially generating decent rental yield. Unfortunate part of the residential real estate is that the rental yield is very low. If the appreciation is good enough, probably that makes sense. But you cannot escape equity. Lump sum versus SIP. See, even in today's market, with most of the market, we generally avoid getting into lump sum. Market where when it's corrected, so we generally when there is a news that is happening today, we prefer staggered investment. So any money that is coming in today, for me also, we put in about 30-40%. Balance amount we prefer to stagger. So it all depends on timing. So the time that you are investing, that is more appropriate for lump sum or SIP. How many funds to invest in? We believe 5 to 7 mutual funds are good enough. Because when we invest in 5 funds, indirectly you're investing about 250 stocks. When you're investing about 7 mutual funds, you invest roughly about 350 stocks. With these many stocks, I think there is a possibility for you to beat an index of 500 stocks when we talk about Nifty 500. But when what we notice in people portfolio, we see people portfolio having almost 20. We've even seen cases of 60 mutual fund schemes. There is no way somebody can beat the markets with that kind of diversification. So I hope this part is clear. What are the most common mistakes by the investors? I'm keeping track of the time here so that we don't overshoot. Unprepared for retirement. We met people who are at 60 and the amount is not sufficient. I told you about a case in Delhi where the elder kids are yet to settle, and then the amount that the gentleman is left with for retirement is again not sufficient. So what should somebody at 60 do? So at 60, so there is no straight answer. I need to sit with you individually. We have a team of investment specialists. They'll be happy to sit with you individually. And those of you who want to reach us out, at the end of the session, we are going to leave a QR code. You can scan it and send out your questions. And all those people who have already sent us questions, we are going to respond to you one-to-one. Now, somebody who's already reached 60, here there is no accumulation here. There is only optimizing. So we are trying to optimize what are the investment that you've already got, whether they are rightly positioned based on your requirement. In some cases, we will tell you probably to reduce your expenses because it may not be sufficient for you to continue through your retirement. And where we feel that, okay, the amount is sufficient, we will tell you so. And ultimately at 60, all that we can do is optimizing and ensuring that your investments are in the right products. Because mistakes at this point of time, it becomes irrecoverable, right? It becomes very difficult to recover from mistakes at this age. We will be happy to address those kind of questions. So, poor diversification. So either over diversified, we spoke about mutual fund. Also, we even meet investors with 200 stock portfolio. Blind investments, allocating funds without understanding. This is one thing that I'm very clear. If the client don't understand the product, as an investor, don't make the investments. As an investor, just because your friend is investing, neighbor is investing, somebody else is confident, comfortable, please don't. I think it's a basic responsibility for all of us is to understand, because ultimately these decisions will impact our lifestyle, our retirement. It's very, very important for you to know. If I'm talking about SIF, specialized instruments, so you cannot make the investment into SIF unless you completely understand the product, and we will be happy to educate you sufficiently before we take you through the investments, right? So diversification, either over diversification, or we also meet people who have got stock options. We meet people with 95% of the portfolio with one single stock, right? We see that. So I think this is what we notice. Low liquidity. So we meet people investing into a lot of lock-in funds, right? So also that there's one more thing: concentration risk. Everything too heavily into one asset class, be it real estate, anything else, even equities for that matter. Taking too much or too little risk. So I've got a classmate. She was a topper in my MBA. Finance. She chose a profession into training. So we met after a long 25 years after her MBA. Then realized that despite she being a topper in a finance, MBA finance background, she chose to put all our investments into FDs, fixed deposits. So I think that's what happens. I think either you take too little risk. I think that's not required at all for her. But I think we find those cases also. So delayed start. I think so. Retirement, I think ideally should be done below 40, 45, but not beyond 50 for sure. So there's a simple model that we've created, especially I have created, to show you, because ultimately we make all these investments, and then overall from the top down, what should our overall portfolio look like? And everybody's portfolios has three components, not necessarily all the three components, but these three components. So one is low risk bucket. So there has to be a portion of our investment which should not carry low risk. They can be in liquid funds, they can be in arbitrage funds, they can be in FDs. Then there is a compounding bucket. I think once we take care, I think what is forming component of a low risk bucket? Planned expenditure. If we know that we need to fund our daughter education 6 months later, 1 year later, or there is a wedding that is happening maybe 1 year later. So this is a planned expenditure. Any planned expenditure which is happening over the next 1 year, 2 year period should not sit in equities in my view, or should not be invested into any high risk portfolio or illiquid portfolio. That has to be sitting in low risk liquid bucket. I think you should be able to liquidate that at any point of time. Second one is emergency fund. All of us require emergency fund. If we are working, we require about 6 months ka salary, or if we have retired, we require maybe 1 year ka expenses as an emergency fund. So I think this is a formula. Third, we spoke about strategic allocation. What is strategic allocation? I have maybe 10 crore rupees. Out of 10 crore, I know that I need to have at least 3 crore into low risk. That 3 crore can include my emergency fund, can also include my planned expenditure, right? Ideally. So this is what I call it strategic. As a strategic, I need to have so much of my assets in safe liquid assets. So what is tactical? I sold a property, I got some cash flow, but this amount is meant for long-term investing. But market is volatile today, but I don't want to dump in, so I invest into some liquid fund and systematically transfer maybe every month, every time market drops, I'm going to transfer. So tactical is a temporary thing, which eventually I'm going to move to compounding bucket. What is compounding? Anything that, see, if my money is growing at 15%, I'm doubling my investment every 5-year period, right? So this is how compounding works. Equity mutual funds help us compound good quality portfolio management services, even alternative investment funds, good quality. So even there, we'd like to take you through some of the hand-picked best funds that suits your requirement, depending on we understand your requirement, and then recommend whether some of these funds should form part of your portfolio or not. Now, last one is direct equity portfolio. Because I have not seen many people not able to compound their money in the direct equity portfolio because of not booking the loss or having too many bad stocks in the portfolio, I don't consider this part of compounding bucket. But there are a handful of people that I met who are very disciplined. They are able to beat the market over the last 10-year period, 20-year period. They are comfortable having this. So I think for them, yes, direct equity portfolio has to be part of the compounding bucket. Now, high risk. See, if you are by and large happy with a 15% kind of return, you don't have to move to the high risk bucket at all. I think equity mutual fund, PMSs, AFs, or even direct equity portfolio, they take care of it. But when you feel, some of us feel that probably I'd like to set aside about 10% of my investment, where I don't mind taking some risk, but I want this 10% to generate maybe 20% or 25% kind of return. That's where we start exploring these investments, what is venture capital, private equity, or even micro cap investments, or even unlisted. So everything requires an approach. So when I present this model, we can actually decide on what portion of capital should be lying here. Say for example, if we decide 20% is in low risk bucket, 70% in compounding bucket, maybe 10% in high risk bucket. Or somebody might say, I don't want anything in the high risk bucket. I'll want 80% in the compounding bucket and then 40% in. So this will set the frame for you to understand this is how my portfolio should be, and then decide on the individual investments. It's not the other way. You don't decide the investments and then portfolio will not look systematic. So on the top-down level, I think this is the approach that we recommend, that you define how the portfolio should look like and then decide the individual investments. Key questions to ask: what is the purpose of investment? I think generally this is the question that we ask. Somebody says that, okay, I've got 50 lakhs to invest. He is 50, 60. So then where to invest? I cannot decide on the choice of instrument depending on the person's age. Most often we ask, what is the purpose of this investment? The person says this is meant for my retirement. Then my approach is to go conservative. If the person says that I have taken care of my retirement, I'd like to invest on the name of my children, grandchildren, then the approach is different. So defining the purpose is very important before investing. Do I understand that we've already discussed? You need to understand every product and the risks involved for every product. Do I need this fund? When do I need this fund? So what is the time frame? So if you're investing in a product, when do I need this fund? Is it 1 year, 2 year, 5 year? So depending on that also, the choice of instrument happens. Do I need to dip into this fund for any emergency if the market crashed? And if you need to dip into this fund, that's the worst case scenario. Right? So markets crash. That's when I think you should have the ability to not touch the funds. So what is my risk appetite and tolerance? I think every investment choice depends on these questions. And if you're able to question yourself these kind of questions, if you have the proper answer, there's a fair chance that your investment decisions can go right. We will pause here and then open up for any Q&A.
What kind of retirement planning can one start at the age of 60?
As I said, here at 60, I presume there is no earning that is happening, there is no accumulation that is happening. We need to talk about optimizing your investments. We need to have a sense of, first of all, 62 life expectancy, we look at 80, 85. So we are talking about 20, 25 year periods. So we need to understand your current lifestyle, what is the monthly requirement. So first stage is, we will assess based on your current lifestyle, what is the amount that you require versus what is the amount that you have. So there are two possibilities, either you are in surplus or in deficit. If there is a deficit, then we will need to advise you to probably cut short on your expenditure to suit based on what you have. Then the second case, where you have a surplus. So surplus gives you cushion, comfort level once you take care of the requirements. I think this surplus can be handled separately. So depending on the risk, I think we can define the purpose of the surplus again as to the safety versus growth. So we can also define that maybe 30% of the surplus can be safer, 70% can be growth. So then we decide the instruments. So there is no straight answer. We need to sit with you, assess these basic things, understand, okay, how much corpus that you require, depending on that, whether the investments are sufficient to take care of this corpus. We will be happy to connect with you and then address that question. Next.
What are the risk mitigation strategies for retirement fund investment in equity and mutual funds?
So we spoke about the dilemmas. While connecting the dilemmas, we already spoke about what are the risks that the equity investors have. So one is the concentration risk, where you have too little or too diversified situation. And the second thing, because inherently no investor like to book loss. I think these are the mistakes that people can avoid while managing the equity portfolio. Because if somebody approaches with the concept of not booking a loss, eventually, believe me, 50-60% of the portfolio becomes non-performing. over a period of time. Even within 1 year itself, somebody's 20% of the portfolio can become non-performing. I think that's what I think somebody needs to advise you right. Or if you are qualified, you have experience of managing equity portfolio, that's all right. But coming back to retirement planning, my recommendation would be mutual funds. Within mutual funds, as I said, we can choose between hybrid mutual funds, aggressive hybrid, and balanced advantage mutual funds, even SIFs. So I think these are all things. Again, we will be able to help you review the portfolio. Again, how many mutual funds to have, that also we've clarified. To create retirement cash flows, I don't think somebody needs more than 4 mutual funds. Because if you have too many, I need to create SWPs from so many mutual funds. So again, choosing whether you need to have a proper equity mutual fund and all those mistakes we spoke about, somebody investing into sector mutual funds and then not tracking it. So if somebody avoids all these don'ts, I think we've already discussed about, I think you have a fair chance of keeping it simple. I think the whole objective of the retirement plan, I think if you remember one of the slides, one condition has to be simple. The entire plan has to be so simple, right? So I think if you are able to follow the guidance, then it's going to be fine.
What are the best sources for regular income flows without depletion of capital?
See, one is the famous FD, but that serves you only for a portion. If your requirement is because this is not going to serve the other purpose of inflation beating, right? Everything has its pros and cons. The filter that I spoke about earlier has to take care of it. But if you are okay not beating inflation, but probably should you have fixed deposits as a portfolio? Probably to the extent of maybe 10% of the portfolio or some portion of the portfolio. But what is it doing? It's not beating inflation, right? So to create a cash flow, probably you need an element of risk. As I said, I think to create the consistent cash flows, there are 2 ways of looking at it. Creating cash flows from the fixed income. What is fixed income? FDs. There are some interesting pension plans. The risk with FDs is that every 3 year, 5 year, when you renew, the interest rates need not be the same. But which is different in case of pension plans, some of the pension plans. We've got some of the very interesting pension plans which our team will be happy to take you through. What happens through a pension plan? You are locking in the return from today to the next 20 year, 30 year, 40 year period. I think that's the best case for pension against an FD. So I think one is the pension plans which you can create a cash flows which is going to be constant. Again, pensions don't beat inflation. So ideally what we do is we create a mix of these pension plans which are a component of guaranteed fixed amount that is coming in and top it up with a combination of SWPs through mutual funds. So it will be a right balance of having a component of debt, security, guarantee, plus ability to beat inflation, ability to grow capital. So no single product can address all your requirement. We need to create a combination of products that can address a specific requirement. And no requirement can be common to everyone.
What are your thoughts on secure AA corporate funds with returns of around 9 to 11%?
See, today when I'm looking at corporate FDs, they are offering the returns in the range of 7.25. If I'm talking about Bajaj offering 7.25, maybe for senior citizen, another 0.35 extra. I think they're in that range. If you're expecting higher return, probably you need to compromise on the credit quality. Probably you can go down until AA rated. Generally, I don't recommend post-retirement to compromise on the credit quality and expect high return. There's a lot of instruments that talk about maybe 12%, 13%, but that's not an investment that I recommend for post-retirement, unless you've got the ability to evaluate them, evaluate the risk. Some of the names sound good, they offer 12%, but rating profile is single A rated. If somebody is expecting 12%, then the rating has to be compromised. So unless you have the ability to evaluate them individually, or you have an expert guidance, generally post-retirement I don't recommend to someone to go below AA rated paper.
SIF versus PMS, what are the pros and cons?
Both are different products.
Who should we go for? Yeah, that's
right. Both are different products. One is that PMS is long only, which works like a regular mutual funds or a stock portfolio. In PMS, you're actually holding stocks in your own demat account. Fund manager is maintaining that, right? So SIFs are like mutual fund. They're operating on a pool concept. So one end, pool means okay, fund manager is maintaining, and then you're getting a NAV. You don't necessarily have the demat account and everything. So the advantage is taxation. SIFs are better off, just like mutual fund. You are entering today, until you exit, you are not paying tax. PMS, you need to pay advance tax every quarter, every month. So SIFs, again, just like mutual funds, are diversified. None of us invest into single SIF. But again, a single PMS strategy will have a 30-odd stocks. That means the chances of these 30-odd stocks in a moving up market are better. If we are talking about a bull phase scenario, PMSs tend to do very well. But in a very volatile situation, PMSs, because it's a concentrated portfolio, they can be volatile as well. SIFs have been introduced to bridge the gap between mutual funds and PMS and AIFs. Actually, not PMS, it's actually bridge the gap between mutual fund and AIF. Because AIFs category 3 have the ability to hedge, have the ability to leverage, but have the ability to short also. But SIFs, as the regulations are defined, number one, they can have 3 components in the portfolio. One, long only portfolio, that means they have a bunch of stocks they're invested. Second one, they can hedge it. They can use options to limit the downside. They can use put options to limit the downside. Number 3, they can, if required, go naked short. That means, okay, so in case if market is falling, they feel that IT stocks are falling. They can actually go short on IT stocks to the extent of 25% of the portfolio. So by this, what happens if the fund manager goes right? Again, if he goes wrong, there's a problem. It's a double-edged sword. If the fund manager goes right, there is a possibility of the fund making returns even while falling market. So we've seen the SIFs have been introduced only recently. We have barely history of about 6 months. We've seen some of the funds have done well in a falling market. Just to talk about, if the market has fallen about anywhere between 10 to 14%, some of these SIFs have fallen by about 3 to 5%. So, which shows that they have acted as a risk minimizing mechanism. They have done well. In fact, some of the SIF fund managers have been managing AIF portfolios for the last 7 years. So, though they have started now, there is a history that we can track on as to what the fund manager has previously done. So, we don't look at the fund alone. We look at the fund manager. What is the person background? What are the funds that he managed before, he or she managed before, and what is the experience before. So, we will be happy to assist you in terms of choosing the right funds.
How much saving will be required to retire considering inflation rate and interest rate? I mean, the user is asking that considering the expenses, how much time should the savings be in comparison to your expenses?
We've already used the financial calculator where we have clearly explained. Let me give you a rule of thumb. So approximately you need about, assuming that you retired today, for someone who's already 60, retired, if your monthly expense is about 2 lakh rupees, roughly your requirement of retirement funds is about 6 to 7 crore. About 300 times of your monthly expenditure is the rule of thumb. But same is not true for someone who's yet to retire. There are 2-step process. Yet to retire means, okay, if you are at 40, I need to factor in inflation between 40 to 60, right? Or 40 to 55. Then on that, say for example, you're saying your requirement about 2 lakh rupees today and you're 40, you're going to retire at 50, 10 years down the line. Actually, in 10 years time, the requirement of 2 lakhs itself is going up to maybe 3.8 lakh. Then I need to apply this 300 multiple on 3.8 lakh, not on 2 lakh, right? So there is a bit of complexity which will require you to take assistance from a professional. Towards the end, what we'll do, I'll showcase one QR code which you can actually scan and then drop in your question there. We will be contact you. Our team will be able to contact you once again. Let me just share that QR code as well.
Please include a topic on already retired person as well, because generally we speak about those who are young people who are at the stage of retiring. What is your view about those who are already in the retirement phase, like already retired?
See, I hope you can see this QR code, right? See, this we've already addressed. So if I'm working with someone who's at 40, 45, 50, then we've got time to plan. Now, if you're working with someone at 60, 65, even 70, now I need to talk about how to optimize the current investments for maximum benefit. So we just need to ensure that the current investments are rightly positioned, right, to meet the objective to the extent possible. If we've got a scenario of somebody who's got a saving of 3 crore, but his retirement calculation is working out to 5 crore, there is only one thing that I can do. I can only request the individual to reduce the lifestyle and reduce the expenditure. Otherwise, there is no way the person can sustain the period. So I think everything is possible. Number one, what is possible with this retirement planning is that you are more aware. You become knowledgeable as to whether the saving that you got today is sufficient to completely live your retirement life, or if there is a shortfall. If there is a shortfall, you can actually reduce your expenses and still maintain the lifestyle, right? Or if there is a surplus, we can always tell you how to manage the surplus separately. So we have solutions for everyone, not just for someone who's yet to retire, but also for someone who's already retired, in terms of helping you optimize your returns.
Given the geopolitical turmoil and market-related uncertainties that are on, what is the retirement corpus a family should look at for a outgoing of around 2 lakh per month, and what is the asset allocation that they should be looking at in the portfolio?
See, from the retirement perspective, so what someone will require is a holistic plan. But since the question is about retirement planning, I've already given you a simple rule of thumb. I assume that family is already at the age of retirement. So at 2 lakh per month, the assumption here is that we are assuming 6% inflation and 8% post-tax return. Post-tax return. That means, okay, so if you're, because post-retirement, we don't expect money to be sitting in equities. It has to sit in instruments. As I said, okay, so we are talking about hybrid mutual funds, aggressive hybrid, SIFs. These products perhaps can deliver you about 10% in return, but over a 25-year period, it helps to be conservative in terms of expecting a lower return in terms of calculation. But eventually, if they end up giving you higher return, then the plus side is that at the end of it, you will have corpus left, which you can create a legacy. Now, for someone without having any other details, if I'm assuming that 6% inflation, 8% growth rate of the money post-retirement, you have a 300 multiplier. That means, okay, I'm talking about roughly 6 crore of retirement corpus that is essential on the minimum side, right, for a family. Now, question is that where to put this amount, right? So that will depend on various factors. Since you already mentioned in this kind of volatile situation, what one needs to have. One thing that we spoke about, systematic withdrawal plan. So which will have a component of debt, equity, everything. That is one part of it. Second one thing that we spoke about, having some good quality pension plans. So where the good part about pension plans, there is an element of guarantee. So with mutual funds, though I am using debt, even debt mutual fund, I cannot talk about guarantee here. So the returns are market linked. But because I need to beat inflation, I need to have components invested into mutual funds. Now, because I also worry about markets being very volatile, okay, the geopolitics, all these kind of scenarios, which at times is scary, I also want an element of baseline security. That means, okay, irrespective of what happens to the market, I want so much minimum amount to hit my bank account every month, every quarter, every year. So that is possible through pension schemes. I think what is beauty about pension schemes is that you get the same kind of return locked in for the next 30-year, 40-year period. That's the beauty about pension plans. So we have evaluated some of the very interesting pension plans, which we will be happy to talk to you at the larger forum. We don't like to discuss the names because everything is about suitability. Every product is different from the other product. We will be happy to talk about suitability when we interact with you personally. So we request you to scan this and leave, and we will be happy to call you back and then address your questions. So when we spoke about SWP, when we spoke about pension plans, you can also have some liquid funds versus arbitrage funds. So the actual ideal mix can be spoken about only when we meet person, because no haircut is good enough for everyone, right? So which has to be customized. We will be able to customize this for you.
Name a few safe investment options during these volatile times, especially considering the war situation, which is expected to go up till 2032 as per the participant.
See, if you're talking about complete safety, it can be bank FDs, pension plans. It all depends on whether you want investments. Again, purpose of the investment is basically to keep it safe, or you need to generate cash flows. So everything, there is no straight answer. So as I said, okay, there is a matrix where I've asked various questions before you decide the right investments. What is the purpose of investment? Do you need cash flow? So what is the level of risk that you can take it? Do you need to dip into what is the time frame that you got? So based on all these things, and do you want it to beat inflation? First of all, if the purpose is basically, see, I think even if you don't beat inflation, the problem is that your money value is eroding with the time, even if you don't do anything. See, I think what is the biggest risk? The biggest risk is that post-war, every country is going to print currency, which is certain. And currencies are going to devalue, depreciate rapidly post-war. Generally, this is a common thing. That's the reason. So the gold, investment in the gold, everything goes up because that's a limited quantity available. So people end up investing into gold. They tend to do well post-wars. So the biggest risk is that currency losing value. Currency losing value is the biggest risk. So from that point of view, we need to play a balance between instruments that take care of my value of my investments. I should not allow my value of investments to go down, which will be possible through mutual funds, SIFs, and these kind of instruments. Then pensions as a base level security that we spoke about, and a mix of arbitrage funds and everything. I think this a combination. How much of what will depend on again individual to individual. So depending on whether I need to generate cash flow, whether I need more of security, more of safety, so less of growth. So it's a line. I think that we need to shift the line as to more tilted towards growth or more tilted towards security. I think we cannot be in either extremes. Either extremes will not help. So we need to be positioning ourselves at a point which is actually good for us logically, even psychologically also. Right? So I can talk about one example here. There is one gentleman who is invested for a hotel, who works for a hotel, 5-star hotel. He was in charge of the laundry, the entire laundry, and he's a very senior person. He was having some 5 crore worth of ESOP stock options, does nothing. Then we spoke to him about some mutual fund options and then PMS's options. Plus, having 5 crores locked into a single stock is not good. We spoke about diversification. It's in fact. So we met him twice. Both the times he told us his story. He's a Kashmiri Pandit, came back from Kashmir, he used to have properties, they left everything, and he doesn't have the risk appetite. He says, I don't have the risk appetite to see my portfolio. Having seen that, the ESOP's portion is anyway subject to volatility in the market. Right? So that's about psychological risk. So the person is anyway going through a risk, but psychologically he is not comfortable seeing his investments erode. So I think both are important. I think while suggesting a plan, I need to look at both your tolerance for risk as well as this ability to handle it mentally. I think there is some question one gentleman is asking. Let me address that. Yes, Mr. Vimal, if I retire today, can I take pension plan? Yes, absolutely. See, I think it's not either pension or SWP, as I suggested. SWP has to be the base one, and then which has to be topped up by a pension plan. So you cannot ignore SWP for sure. You can only top it up by a pension plan. Because in a long period of 20-25 year period, you need to beat inflation, right? Which a pension plan doesn't do. But pension plan provides a base level security, irrespective of what happens. So there is one factor which is going to be constant, which is going to be offered by a pension plan. So SWP has to be the number one, which you need to top up by a pension plan. So request you to click that link and then leave your numbers, details. We will be happy to speak to you individually, and we will be happy to reach out, understand your specific requirement, and address your query. Thank you so much.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.